Good morning. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX Global, bringing you the morning comment for the 3rd of February. Reserve Bank of New Zealand Governor Wheeler dampened expectations for further rate cuts as he stated that it will be inappropriate for the bank to cut rates in order to offset the temporary effects of low oil prices. On top of that, he repeated that the effects of the previous cuts may not be apparent yet. Bank officials may feel even less pressure to act after the unemployment rate released overnight declined significantly in Q4, beating expectations of a minor increase. However, if concerns around the global economy deepen, officials may need to adjust the rates again to ensure the rise of inflation and the improvement of New Zealand's economy. The Kiwi strengthened on both the governor's comments and the fall in the unemployment rate, and could remain supported as the markets price out further easing from the Reserve Bank of New Zealand. Elsewhere, Bank of Japan Kuroda mimics Draghi. Similar to ECB's Draghi, Governor Kuroda stated that there is no limit to the measures for monetary easing and signaled the bank's readiness to cut rates again. He countered criticism that the bank is running out of policy toolkits and said that if the current measures are not enough, officials could institute new tools to meet their inflation target. While the governor did not offer many clues on what could be the trigger for further easing, he did state that the global volatility and slowing emerging market economies could discourage firms from boosting wages. Such external risk could hurt Japanese business sentiment, which may delay inflation from reaching the target. As for today, we get the final service sector PMIs for January. From the countries, we go to manufacturing data on Monday. The final forecast for France, Germany, and Eurozone are the same as the initial estimates, so no major reaction is expected at these releases. In the UK, the service sector PMI for January is forecast to have fallen somewhat from the previous month. Bearing in mind the mixed results of the manufacturing and construction PMIs for the same month, the service index could provide more evidence on how the economy has started the year. Services account for the vast majority of the UK GDP, and therefore a possible decline in the services PMI could confirm that the UK economy had a soft start in 2016. From the US, we get the ADP employment report for January, 2 days ahead of the NFP release. The ADP report is expected to show that the private sector gained 195,000 jobs, fewer than it did in the previous month, where the print hit 257. Nevertheless, this is still pretty close to the 200,000 mark and also in line with the Fed's view that the labor market indicators continue to strengthen. Although an unreliable predictor of the NFP number, this could increase the likelihood that the NFP print on Friday may also come near to 200,000. The ISM non-manufacturing PMI and the final market service sector PMI, both for January, are also coming out. The market generally pays more attention to the ISM figure, which is expected to have fallen. Given that the ISM manufacturing index for January remained below the 50 line for the 3rd consecutive month, a decline in the non-manufacturing index could cause the dollar to lose some of its recent steam. For more information, including technical analysis, please read the full comment on ironfx.com or download our app and get all the information you need to trade delivered directly to you. And also, follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX Global, wishing you solid trading.